All right, good evening, everyone. My name's David Wilson, and most of you guys here either own property, or if you're new, maybe you're looking to buy a piece of property. And if that is true, you have most likely either been sitting across the desk of a banker asking for a loan, or you soon will be. And so tonight I want to talk to you about what a banker looks for in a loan applicant. It's if you're to use some internet jargon, it's going to be a AMA, and I'm the banker, so ask me anything. So if you have any questions as I'm going along, just raise your hand, and I want this to be as interactive as we can. But just to give you a little bit of a background on myself, I've been a member of this organization now for a couple of years, and I've really enjoyed it, and I've enjoyed the speakers and learned a great deal, not only from the speakers but also from being around the folks here and meeting people and discussing and different information and lessons learned from this. So it's a real pleasure for me to be a speaker tonight, so thank you for having me. But I've been in banking for 15 years. Currently, I'm a loan officer at Bancorp South. I bought my first rental back in 2002. And I was thinking, well, that wasn't that long ago, but then you do the math and you're like, wait a minute, that time goes quickly. So I'm currently up to 14 rentals. So needless to say, I stay quite busy between home life, family life, the rentals, and my job at the bank. But when you're sitting across the desk from the banker asking for money, asking for a loan, it's hard to know exactly what he may be looking for, and but it may not be as complicated as you might imagine. Has anybody ever heard of the 5 C's of credit? Is that term? Can you hear me, Terry? Better. The 5 C's of credit. This is a kind of an easy way to remember some of the major aspects of what we look for in a lender. So the 5 C's of credit. The first one is character, and that encompasses a lot of things, but one of the main things is credit worthiness. And we're going to circle back to this, and I'm going to go into more detail on what credit worthiness is, but that has to do with your credit report and your credit score. The next thing is capacity. Capacity is your ability to repay the loan, and that has to do with things like debt to income, cash flow, and that sort of thing. So debt to income is a very important figure that bankers look at. And what that is, if you take your monthly debt payments, okay, and your debt payments are things that are for your mortgages, your car loans, credit card payments, what you owe money on. Not the grocery bill, not the child's daycare, but what you're using to repay debt. You take that monthly figure and divide it by your gross monthly income, and that gives the banker the debt to income, the DTI. And what each bank is a little bit different, but a lot of banks, the magic number is 40%. We don't want an applicant to be over 40% with the new loan. So if you come in asking for a loan and you're at 39% already, you don't have much leeway. So after the new loan, we want a score of 40% or lower. There are some exceptions to that rule. There's exceptions to lots of rules, but sometimes you can go up to 45. Some banks, depending on the person's income and the circumstances, may even go up to 50, but 40 is what you need to try at. And so everybody can calculate their DTI. And if you have any more questions about that, or if you want to know what yours may be, I'll be happy to talk to folks afterwards too. So that's capacity. The third one is capital. Capital is what you've got into the loan. So that would be your down payment or your equity. So if you're purchasing a home or an investment property, what are you putting down on that? Bankers like to know that you've got some skin in the game, so to speak. So the fourth C is collateral. Collateral is what you're putting up to secure the loan. There are some loans that are unsecured, of course. Those are, all things being equal, more risky loans as far as the bank is concerned. But a secured loan, and in the context of rental property, it would be the rental property that you're putting up for the collateral. We have a term LTV, that's loan to value. And depending on the type of collateral and the type of loan, we will, there are different amounts of LTV that we will accept. If you're doing a conventional 30-year mortgage where you're purchasing a loan, the LTV may be close to 100%, if not 100%, if it's a VA type of loan or situation like that. If it's investment property, chances are the LTV is going to be 80% maximum. There are other loans where it'll be even less. So if you're buying raw land or a lot loan, in certain situations like that, loan to value can be maybe just 60%. The collateral is very important for the banker, because if in the event of a default, the banker will have a better chance of making back the money. So the fifth C is the conditions. The conditions has to do with the actual specific terms of the loan, and has to do interest rates, the amount of time that the loan is going to be paid back if there's a balloon, that sort of thing. The purpose of the loan comes into play as well. So that's just a brief summary of the 5 C's of credit. It's not rocket science. It's it can get a little more complicated when you're talking about commercial loans. But circling back to that first C that I mentioned, character, or what we call credit worthiness. We get a lot of information on your credit report from that, and everybody's familiar with credit report. There's a lot of people have apps on their phones. Who has heard of Credit Karma? Does anybody have that on their phone? So are you able to get your credit score just by pulling up your... Yeah. You don't use it? Some people do, and so that's a great resource to have, so you know what your credit score is all the time. But when we pull the credit report, there are several things listed on the credit report that we look at, and there are 3 major credit reporting agencies that produce these credit reports. There's TransUnion, Equifax, and Experian. They're very similar, a few small differences between them, but your credit report's going to show the FICO score, and that's your credit score, what people commonly refer to as credit score. Sometimes they call it a beacon. And each credit reporting agency has its own formulas and algorithms to determine what that is. They usually range anywhere from 300 to 850. There's a lot of things that go into the credit score, but your main goal is you want to be in the 700s. Okay, that's where you're going to get the best kind of interest rate, and that's where the lender knows that you've got some good credit experience, and the likelihood is that you're going to pay back the loan based on your credit history. So, but if you're not quite at 700, that's okay. You can still be qualified for a loan. 640 is kind of where the dividing line is between prime and subprime. So you certainly want to be above 640. And then eventually your goal is to get to 700, okay? What drops the credit score the fastest way is when people pay back their loans, their debts, slowly. So if you're late paying, the magic number is 30 days late. If you shouldn't be in the habit of being late at all, but if you're a couple days late, that's not going to show up on your credit report. That's not going to affect your credit score. But if that bill gets, lost on your desk, and then you find it the next month, and it's hit 30 days, you've just been dinged, and that's gonna affect your credit score. And that's when I'm looking at a credit report, that's what I see that affects negatively most people the fastest. So don't be 30 days late. If you're 30 days late, that's just going to really bring you down quickly. So past dues will affect that FICO score. The other thing that affects the FICO score is your ratio of outstanding debt to what you have available. So if you have a credit card with a $10,000 limit and you're at $9,900, that looks worse than if you have let's say a credit card of $20,000 and you're only at $12,000. Even though you have more debt, you have more way to go. You're not maxed out, so that also can negatively affect your FICO score. But in addition to the FICO score, credit reports also show public records. So if you've been sued or there's a judgment against you, that can show up on the credit report. If you're past due on child support and the state has gotten involved, that can show up on your credit report as well. Collections, bankruptcies, and that sort of thing. One common misconception is that people think that after a few years, that can go away. Well, that's not exactly true, because that stuff will stay on the credit report for longer than that, but it may not affect your credit score as drastically. So if you had it may still be there, but it won't. The longer as time goes by, it won't negatively affect your credit score as quite as much. Yeah.
On that loan to value, what value do you decide to look at? Is it going to be the appraisal?
Right. So that's a good question, and it depends. So there's two values that we can look at. It can be the appraisal, but it may be the purchase price. If you've just bought the property and you haven't done anything to it, and let's say you pay cash, and then you're going to go to your lender to refinance, we're probably going to use that purchase price, okay? Unless you've owned it for a number of years and then the appraisal comes in higher. Or unless you have put improvements into it and you can show me those improvements, then we can order an appraisal, and if the appraisal comes in higher, that makes sense. But don't think that, if you find a good deal, you pay cash and you go to, and then you go run to the bank, and then a month later you're going to actually borrow more money than what you pay for that property. That's usually not going to work. But if you've held it for some time and property values go up, then that may be possible.
So did you order an appraisal?
Right, it depends. In most circumstances, the bank will order an appraisal, or they may do what's called an AVM, which is a kind of a shortcut. It's not a full-blown appraisal, but it's a electronic search, and what they do is they take the parameters of the home, compare them with other homes in that zip code, and kind of come up with a number. Now you have things like Zillow that a lot of people are familiar with, and so you can get a pretty good idea of what homes values are. Mm-hmm.
So with the refinancing of the property, you don't use the purchase price of the property. Do you also include the rehab costs when you get ready to do it?
Right. So if you've purchased a property and then you put money into it, rehabbing it, updating it, and stuff like that, then the banker can use, won't be just shackled to that purchase price. We can order a new appraisal, and then hopefully that appraisal will come back higher than that purchase price, and we can do the loan to value off of that new appraisal that takes into account the work that you've put into it.
So you don't have to have the property a specified number of days in order to make that happen?
If you put improvements into it, no. Now, if you've bought it and haven't done anything to it, and you're like, well, I just got a good deal on it. Zillow says that this property is worth $50,000 more than I paid for it. chances are you're not going to have a banker give you a loan based on that deal if you haven't done anything at all. Now, if you've owned it for 2 or 3, 4 years and the property values have gone up, then yeah, we might use an appraisal off that thing. But yeah, does that help?
Yeah, I'm
Okay.
trying to make sure I understand. So
Mhm.
if I bought it for $50,000 and I put $15,000 worth of repairs in
Mhm.
within 30 days, you're saying that I can use the $50,000 purchase price plus the $15,000?
Well, in that case, what we're going to do is we're going to order an appraisal, and that appraisal will take into account the work that you did, and then you would certainly want to make sure you point that out to the appraiser that comes by.
Thank you.
Question?
Do you need subject to appraisal?
I'm sorry, subject to appraisal? Yeah, so we can do that too, and that absolutely. Yeah. Okay. So, one thing that people often ask me about is when we're talking about their credit score or we're looking for a loan, are inquiries. And people are oftentimes concerned about the number of inquiries on their credit report. There are two types of inquiries. There's a hard inquiry and a soft inquiry. A soft inquiry happens all the time, and you probably all have a number of soft inquiries on your report, but those do not affect your credit score. Those are done every time you get a credit card offer in the mail. Typically, they do a soft inquiry first, and then they mail you that offer. But don't worry about those. Those do not affect your credit score. Hard inquiries do. So if you go in and you ask for a loan, or you apply for a credit card, or apply for a loan, that's known as a hard inquiry, where the loan officer will pull your credit, and that will show up. But it's not the end of the world. I mean, you would expect there to be inquiries on a credit report. So don't think that that's a negative thing. They fall off after a time too. So a lot of times people get too focused or too I don't know, that they view that too negatively, but those hard inquiries do eventually fall off. And if somebody's, for instance, if somebody's looking to buy a car and they've gone to 2 or 3 dealerships and they're looking at Fords, they're looking at GM products, the lender would expect there to be 2 or 3 or maybe even 4 inquiries on the credit recently. So that's not the end of the world. One thing that folks may not be aware of is that you're entitled to receive a copy of your credit report if you've been turned down for a loan. Have a question?
Is it true that if you have your credit report too many times or over a certain amount of times, you can put them in the
Right. So if you've got inquiries, too many inquiries, that can be a problem. Okay.
Would you consider too many?
Well, if I'm seeing inquiries from car dealerships, I'm seeing inquiries from credit card companies, and I'm seeing inquiries from other banks, and you're in front of me talking about another type of loan, then that can be problematic because you may be trying to get multiple loans, multiple types of loans at the same time. And so that would cause a lender to ask more questions and want to know more details about that. Question?
Yeah, hey, David, with regard to the hard core, I've heard in the past, does it cost about 3 points on your credit, or is that?
Yeah, that's what I've seen. I've seen 2 or 3 points.
Okay, and then you said it falls off eventually. That's a relative term.
Yeah, I'm sorry, I don't have the exact.
Oh, it's okay.
Yeah, I don't know the how long it takes.
No, it's okay, I've never known the answer to that, so that's.
Yeah. Yeah.
2 to 3 points for a hard core, right?
Yeah. I'm not sure. I think it's just a matter of a few months. I don't think it goes a whole year, but I don't know the exact term on that.
Thank you.
Question.
What credit bureau do y'all from?
We happen to use TransUnion. Yeah. Another question?
I forgot.
Okay. That's okay. Yeah. So if you're ever turned down for a loan, you are entitled to a copy of your credit report, and the bank should provide that for you. But even if you haven't been turned down for a loan, you can still get a free copy of a credit report. Does anybody know how to do that? So annualcreditreport.com. So if there's any practical advice that you may be able to take away from here tonight, this may be it. So annual credit report, anybody can do this. You just go to annualcreditreport.com and you can get a copy of all 3 of your credit reports from each of the major credit reporting agencies. Now, if you're going, if you're like a lot of folks, you go to Google and you type in annualcreditreport.com. Be careful. It's not going to be that first thing that comes up. That's going to be an ad. And that's going to take you to somewhere like freecreditreport.com or something like that is not the site you want to be in, because although it's free's in the title, they're going to get you to spend money. So make sure you go to the website annualcreditreport.com. You're able to pull and receive a copy of your credit report once a year. So each of you guys can do that go home and do that tonight. So that's important. Now, one important thing to point out about that is you get the credit report, but you do not get the credit score. If you want the credit score, most of the time you can pay a few dollars or something. They've got these little side features that you can order and get the actual credit score. So. Yeah, go ahead.
Okay, so my question, there was something mentioned about the score dropping 2 or 3 points. Is that per inquiry?
That's right. That's right.
Okay.
Mm-hmm. 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 Okay. Any other questions?
Is there any advantage, David, of a husband and wife not being on the loan or applying for different loans and then having individual credit scores pulled? Maybe they're making multiple investments, et cetera, et cetera.
The primary advantage for a husband and wife to apply jointly is that the bank is allowed to use income from both people. So that's the primary advantage. Of course, so that's what I'd say to that. Yeah.
If I came into your bank and applied for a loan, for a mortgage, based on my income, et cetera, just me, would you want to pull my wife's credit also if she's not on the loan?
If your income is sufficient to cover the debt, then no. If I've been in situations where the debt to income that we talked about earlier came back and it was maybe right at that 40%, and we just, it's borderline. But if we had an additional amount of income, then maybe we could do the loan. So what I've done is I've gone back to the borrower and asked, hey, look, would you be willing to have your wife sign on this? Sometimes they would be willing, and then we can add her to the loan. We get to add her income, and as long as she's not in more debt than you are, or has got a debt that wasn't captured on your credit report, then that would drop the DTI, and then we'd be able to do the loan. So yeah.
Thank you.
Yeah.
I have a question.
Yeah.
Hi, the state of Louisiana being a community property state and you being responsible for each other's debt, and how does that work? I mean, when you said that if he were to come in like that, if his income was sufficient, you wouldn't have to look at his wife. So does it play a part with it being a community property state and you being married and she may have some debt or?
So that certainly comes into play, I think, when things are litigated. How much that comes into play in the application process probably depends on the bank. So in the event of a default or bankruptcy where you're in front of a judge, all that, the matrimonial status and the community property all gets, that's when those state laws come into effect. But each bank has its own policy. The way we work it is that we won't add the spouse's income unless that spouse is a co-signer on the loan.
You can sign something too, or they can sign something separate, yeah, you can,
Yeah. Mhm. Yes, ma'am.
How many years of W-2s do you have to go with?
So it kind of depends on the loan, and it depends on the bank's policy. On some types of loans, we don't require income verification at all. If the loan's small enough, if the person has a lending history with us, we don't require proof of income. Other types of loans, for more money or that, a lot of times we'll like to look at least 2 years, not only of the W-2, but sometimes we want to see the whole tax form, all the 1040. And then in some cases, if it's a commercial loan, we'll want to see 3 years. Mm-hmm.
So what is your W-2, is you have to collect all your income through the mortgage or rent loan?
Oh, absolutely. So yeah, if he just asked you for your W-2 and you have additional income, you certainly need to point that out and say, well, yeah, I've got this W-2, but I also have these 1099s, and I have a rent, and so yeah, you definitely want to make that known.
Are there any entities besides individuals that can apply for a loan, LLC, trust, et cetera, use of property as collateral without dealing with individual returns, et cetera?
So if you want to borrow money in the name of your LLC,
Right.
do you have to turn over your personal returns?
Right.
In most circumstances, the lender's probably going to want to see that. Yeah. So speaking for Bancorp South, yes. Other banks, I would imagine they would as well, but I can't really speak to that.
Okay.
Mhm. Yeah.
Thank you.
Yeah, they want to see everything.
What if the LLC has enough capital in it, and the individual would show you their bank statements, and they're basically just looking for a loan because they don't want to use their cash for a new property?
It could be, the banker's probably going to want to see everything, because although that LLC may be doing really, really well, the other LLCs may not be doing so well. And so the lender would want to do a global cash flow, which is a bit more in depth than just debt to income to see, because it could be, you could imagine, sophisticated businessman, you're going to structure all your winning assets in this one LLC and then have all the losers spread out everywhere else. And so overall, you could imagine that person may be doing real poorly, but it just presents this one LLC forward. So that's why they want to kind of look at everything.
Makes sense. Thank you.
Yeah. Right. Any other questions, or any other experiences that someone may have had with a bank that you want to, talk about, or something, maybe I can speak to or clarify? Yeah.
I'm interested in lines of credit and how those work.
Oh, right.
Personal lines of credit and business lines of credit.
Right. So that's a great question. So there are kind of in general, you can divide loans into different categories, and one way is installment loans versus a line of credit. And so just to kind of back up and give a bird's eye view, and then we'll zero in on your specific question. But an installment loan is typified by the fact that you kind of had a closed-in term. So the loan is for only a certain length of time, and there are set monthly installment payments that are done that are generally fixed. So you know exactly the dollar amount that's going to be due each month. And at the end of that term, the loan is either going to be completely paid off or it's going to balloon and you have to renew it. A line of credit is different. It's open-ended. What that means is when you're given, let's say, a line of credit is more like a credit card. So that, let's say you have a $50,000 line of credit. You sign the papers and you the loan is done, you don't walk out with the $50,000 necessarily. On an installment loan, I'm writing a check and giving the check to you or paying off someone for the $50,000. Line of credit, not necessarily. You can go home and not draw any money out, and you're not charged any interest until you decide to draw the money out. And then if you have a need, you'll come back to the bank and draw out maybe $50,000 or maybe less. So you can draw out as much as you need up to the amount of the maximum amount of the line of credit. Your monthly payment varies from month to month depending on how much you've drawn out. A lot of times lines of credit will be interest only. So we're only going to bill you for the interest that has accumulated. Other types of loans, other types of lines of credit may be principal and interest, or 5% of the outstanding balance, that sort of thing. Lines of credit are typically a bit more risky for the bank, and so we want the loan applicant to have a stronger credit history and that sort of thing, all things being equal. Lines of credit to manage them successfully takes some discipline, because from the banker's point of view, we want to see the activity on lines of credit go up and down, okay? We want to see draws on the line of credit, but then we want to see those payments be made and the line of credit go back to zero. What we don't like is for someone to do a line of credit, take the whole $50,000 off, just pay interest only, and then in a year or two, when the line of credit matures, they still owe $50,000, and they say, well, let's renew this for another year or two. Meanwhile, no interest, no principal has been paid down. That will make the banker nervous. Lines of credit are meant to be paid down periodically. So a classic example of line of credit that businesses use would be for inventory. So if you can imagine a business that has a lot of overhead as far as inventory goes, line of credit would be perfect. So you've got to fill up the inventory, you draw on your line of credit as you sell your inventory, then you pay down on that line of credit, and we want to see it paid down to zero or close to it. And then another season comes and you're taking in more inventory, then you pull off the line of credit. Real estate investors can use lines of credit as well. A lot of times real estate investors will have lines of credit set up to rehab homes. So if you're the type of investor to buy depressed properties and rehab them, line of credit's ideal for you as long as you manage it properly. So you buy a depressed property and you're going to rehab it. You draw on your line of credit to rehab it. Then once you start renting that property out and it's starting to generate rent, then you want to pay that line of credit back down so that you can rehab another one. So that's another example of the ways lines of credit are used in the context of investment property. Yes, ma'am.
So what other documentation you need for
So what kind of documentation you might need to apply for a line of credit? On a line of credit that's secured by one of your properties, we're going to probably need 2 years tax returns and maybe recent pay stubs, and that will give us most of the information that we'll need.
So would the line of credit be based on the property value that you're trying to get the line of credit on? Say for instance, if I got a property and say it's appraised for $50,000. I don't owe anything on it. I don't want to get a line of credit on that piece of property.
Mm-hmm.
So what will determine my amount of line of credit that I can use?
So a line of credit on a investment property that you have rented, on our banks, we'll go 80%, so we'd loan you the $40,000 on that.
So
80% on Bancorp South. Mm-hmm. Hey, Terry.
If I remember, going back a few years, if you used the line of credit on your personal home to buy, say,
A maximum you could do of what?
You can do that 4 times. Use your line of credit on your personal property.
A lot of people do that. They will, in fact, that's how I bought my first rental property. At the time, I owned a duplex. I lived in one side, rented out the other. And this was before I became a banker. I'd owned the property for a few years. Property values had gone up. I took out a second mortgage on the house I lived in. Those are called HELOCs, Home Equity Lines of Credit. And HELOCs can sometimes go over the 80%. A lot of times banks will loan 90% to value or even 95% loan to value on a HELOC. And so depending on the amount of equity you have, you can withdraw a lot of money. And then you can use that money to buy basically anything you want. So if there's another property that you want to buy, you draw on that line of credit to purchase that property. However, you want to make sure that you pay down on the home equity line of credit at a reasonable time, so that by the time that line of credit matures, you can show the banker, hey, I've paid this down, let's renew it. And then when you renew it, maybe you buy another piece of property. You can use that line of credit as often as you want, as long as you pay it down. So if you buy one additional property with that, or 2 or 3, that's okay. What some people have done, and what you may be speaking to when you say there's a limit, is that sometimes banks will, after you have 2 or 3 lines of credit with them, they'll say, okay, thanks, but that's all we need. So typically banks want you to have 1 line of credit, and then any other debt, they want that debt to be an installment fixed loan that's paid off, that has a fixed term that's going to be paid off. They don't want too many open lines of credit on one person. Yes, sir.
Say like if you have a line of credit with a bank and say like the balance on it is 0, but someone's coming in to see you for getting a loan on purchasing a property of some type, would that that open line of credit, would it be looked at as derogatory through your eyes with somebody coming in?
Yeah, so if a borrower comes in, he's asking for money to purchase a property, and he has a line of credit that he hasn't drawn on. He owes no money on it, but he has it available to him. Would the banker view that in a negative way? No, I don't think so. No, not at all. We would think that's a good thing, because that shows that you have the means to maybe purchase this property, but you want to, you're not going to use. Sometimes people do use lines of credit to purchase a property, especially if you want to close fast or if you want to do a cash deal. That's another example that I should have mentioned of the way investment people use lines of credit. So if you have a line of credit and you want to do a cash deal, that's a great way to use a line of credit. The thing is, you want to make sure to do some permanent financing to pay off that line of credit. So if the next deal comes up, you can pull the trigger quickly and you don't have a big outstanding balance left on that line of credit that hangs out there for years and years.
Could you do a line of credit on multiple investment properties, just one line of credit on multiple?
You can. They can be linked together. It's a bit more complicated, but say you have 5 or 6 properties, you put them all together, then what we would do is do an appraisal on each one, and then the total value of those properties, we'd loan you 80% of that total value.
So what is that called? It's called a main credit, or just
It's just a multi-mortgage line of credit. Mm-hmm. So yeah, you can group them together. We can certainly do that for you.
even though the property is inside of LLC? You still can do it?
Okay, so if they're owned by different entities, it becomes a bit more complicated, but no, we can still do it. Oh, just one LLC owns them all? Sure, yeah, absolutely. Ms. Smith?
What sort of interest rate do you charge?
The interest rate depends on a number of things. It depends on the type of loan, the term of the loan, the collateral, and the credit worthiness of the customer. So typically, the longer the term, the higher the interest rate. If the property is unsecured, I'm sorry, if the loan is unsecured, all things being equal, you would expect to pay a higher interest rate on an unsecured loan versus a secured loan. If you have higher credit worthiness, all things being equal, you would expect to pay a lower interest rate than someone with lesser credit.
So is there a thing you can get an unsecured line of credit?
You can do an unsecured line of credit. Typically, you're not going to be able to get as much money. Those lines of credit usually renew on a yearly basis, where if I do a line of credit secured by a piece of property, I can have that as a 5-year line of credit, and we only have to renew it once every 5 years. If you want to do an unsecured line of credit with me, we're going to renew that thing every single year. So you're going to have to get undressed for me, financially speaking, every single year. You know, yeah. Yeah.
Do you do non-recourse loans?
Well, some banks do, but that's not something that we do a whole lot of. Yes, sir.
You do cash secured lines of credit?
Absolutely. We can do those, and a lot of times on cash secured loans, some folks will use those to kind of rebuild credit or establish credit, but we can do those as well.
You like usually a lower rate on those?
Yeah, on a cash secured line of credit, we would give a lower rate compared to certainly an unsecured loan, or even compared to a loan secured by property.
How does that work?
A cash secured loan, so let's say you want a line of credit for $10,000. You would come in, open up a savings account or maybe a CD for $10,000. The account would be in your name. You would own the account, but the bank would freeze the money or put a hold on the money, so you would be unable to withdraw it. Then we turn around and give you a line of credit for that $10,000. Okay, in the back.
If you're applying for a loan, doesn't your line of credit count against you if you get some ratio?
If you have an outstanding balance on the line of credit, then that factors into the debt to income. If you don't have a outstanding balance on the line of credit, we typically don't factor, that doesn't go factor into the debt to income. And we would like people to have room on their lines of credit and credit card. We wouldn't want, if somebody comes in asking to borrow money and they have, 2 credit cards and an unsecured line of credit, and they're all maxed out, that tells the banker a story, and that the person may be having difficult times. So even if everything else matches, as a banker, you're probably going to ask more questions like, what's going on? Did you, have some hard times? Did you or your spouse lose a job recently, or have you incurred more expenses? Yes, ma'am. Ms. Smith.
Does lines of credit show up on your credit report?
Yes, they do. Lines of credit will show up on your credit report, and the amount you owe on that line of credit also shows up on your credit report. Usually that's about a 30-day lag, so it may not be up to the minute, but yeah, we see the outstanding balance on lines of credit as well as other loans that you have, like installment loans.
But if you had some that had 0 on it, will that show up?
Yes, it will show up. Yeah, so we'll know that you have it. We know that you have it available, but you've got a 0 balance on it. Yes, sir.
There's some banks, if you get a line of credit, if you borrow X number of dollars out of there, they will allow you to, take that amount and put it into a fixed loan. So the bank will do that.
So if you have a line of credit and you owe a certain amount on it, and then the bank will allow you to take that and term it out? Yeah, absolutely. Yeah, we can do that. Yes, we can. The way we do it is a separate loan. So, but yes, we can do that. Now, there are some banks that I've heard have a kind of a fancy line of credit. Let's say you have a $50,000 line of credit, and then you draw $10,000 off to make a rehab. Then you can go to that bank and you can take that $10,000 and say, I want to pay this $10,000 off in 5 years or 3 years or whatever. Then they will convert that portion of your line of credit for a fixed term loan. So some banks have that as well. We do it a different way. It'll be a separate loan. So we'll take the $10,000, we'll pay off the line of credit, and that $10,000 now that you owe will be amortized on a fixed schedule, whatever you want, the 1, 2, or 3 years. But it'll be a separate loan. Depends on the type of loan, but yes. And the other one that I referred to, there's fees usually involved to convert it to a fixed loan too. So fees both ways.
Is there a cost to get a line of credit?
Yes, there are. On an unsecured line of credit, typically the cost isn't that much. On any loan that has to do with real estate, there's typically costs. However, on home equity lines of credit that are secured by the residence, the home that you live in, we've got a great product where we don't charge fees. So, and you guys know that it's not just the interest rate that costs you money, it's those closing costs. So if you can avoid those closing costs, if you have equity in your home, at least for Bancorp South, we do not charge closing costs on home equity lines of credit. So that's a great point. Yes, sir.
Do you have a maximum amount that you can loan someone?
Maximum amount is typically dependent on the person's income. So, yeah.
Like, how many overall, let's say if somebody had like 50, 60 houses and one borrow all of them against you, could they do that, or you have a max total that you loan out? Well,
if they showed income sufficient enough to meet the DTI, the debt to income, then yeah, we would. Of course, there would be a couple limiting factors. The income versus debt would be a limiting factor. And then the other limiting factor would be the value of the collateral. And so in this case, if it were investment property, we'd only go up to 80% of the value of that investment property, and then 40% on the debt to income. Or if they make, several $100,000 a year or more, we might bump that number up to 45 or even 50. Okay, any other questions, or? All right, well, I'd like to thank everybody for coming. And if you have any questions afterwards, be sure to come by and talk to me.